In this unit, we turn our attention to the demand for factors of production. Remember that up until this point, we've been describing the demand and the supply of goods and services, what we call outputs in our economy. Goods and consumers are what consumers purchase. And we've looked at how consumers determine their demand for those goods and services, and we've looked at how producers determine how much of a quantity of a good or service to produce and how to maximize their profit and things like that. But all of those goods and services are made from what we call the factors of production. And we've looked at 4 of them. Land, which are the natural resources or raw materials that come from the earth. Labor, which is human labor, the work that we do as human beings to produce those goods and services. And capital goods. Capital goods are described as equipment, tools, machinery, buildings that are used over and over again to produce those goods and services. And of course, the 4th one would be entrepreneurship, or when people combine those 3 resources together to innovate in some new way or produce a new product, and they make a profit from it. So those are what we call the factors of production, or in many economics textbooks and other places, they are called inputs. Well, goods and services are sold in product markets. We saw that when we looked at the model of the circular flow of the economy. And in the product market, firms produce or provide goods and services to households who want those goods and services, and they are exchanged for money in the product markets. Well, the opposite is true in the factor markets. When we look at the circular flow model, factor markets are where inputs or factors of production, land, labor, capital, and entrepreneurship are exchanged. They are owned by households and desired by firms, and they are exchanged by households and firms for money. So in this unit, we are going to look at the demand and pricing of these factors of production. So in this first module, which is an introduction to factor demand, I am going to describe the features that make the markets for factors of production, the inputs, resources like land, labor, and capital, different from the markets for goods and services, which were exchanged in the product market. And I will explain how factor markets determine the factor distribution of income, because when these factors, land, labor, and capital, are sold to firms in the factor market, income is received by households for the land, labor, and capital that they sell. Well, how is that income distributed amongst those different factors of production? We will explore that here. And we'll discuss how the demand for a factor of production is determined in a way that is a little bit different than the demand for goods and services that we've looked at previously. Now, the first thing we look at is what a factor of production is. The economy's factors of production. As I said briefly, a factor of production is any resource that is used by firms to produce goods and services. Goods and services are items that are purchased and consumed by households. Factors of production are bought and sold in factor markets. Goods and services are bought and sold in product markets. So up until this point, we've explored product markets. Now we're going to look at factor markets in the circular flow. And this is where land, labor, and capital are exchanged from households to firms. And the prices that are paid for land, labor, and capital in factor markets are known as factor prices. But keep in mind, sometimes these factors of production are also referred to as inputs, just as goods and services in the product market are referred to as outputs. Now, here's a question to think of. What do you think is the most important price you will encounter throughout your life? The answer for many of you is the price for your labor. Well, your labor is an input. It's a factor of production. It's sold in the factor market. And the price you agree to sell your labor for is a factor price. And so you're a household who owns your labor and you sell it to a firm that desires your labor for a factor price. So in this unit, we are going to study how factor prices, like the prices for labor, land, and capital, are determined, and how firms use these prices to make hiring decisions on how many workers they will hire, how many natural resources they will purchase, and how much capital they will purchase and invest in. Okay? So these hiring decisions, especially for labor, should be of real interest to you. Here's a tip for the AP exam. The factors of production are sometimes referred to as inputs. So if you see them describing inputs on the AP exam, keep in mind that they're the same thing as factors of production. Now, economists will typically discuss 4 factors of production. And as I said, these are often called inputs or resources on the AP exam. Now, think about one specific firm, like a restaurant. And can you provide examples of these resources within that firm? So, one type of factor of production is what we call land. Land is anything that comes from nature itself and is produced by the earth. We often refer to these as natural resources because they're provided by nature, or raw materials. So if you think of that when it comes to a restaurant, it might be flour, it could be wheat, it could be corn, it could be sugar. Anything that is provided by, that is a raw material used in the production of their food. Now we talk about labor. Labor is the work done by human beings. And so in a restaurant, that could be the owner, that could be the cooks, that could be the waiters, people like that. And then we'll skip entrepreneurship for a second, but if we look at capital, capital can be divided into 2 different types of capital. Physical capital consists of manufactured resources such as buildings, equipment, tools, and machines. These are not the outputs or goods and services that are sold to consumers. These are the things that are purchased by businesses to use in the making of those goods and services, and they're used over and over and over again. And they're worn out and they eventually have to be replaced after depreciation. So that's physical capital. But human capital is also important too. Human capital consists of the improvement in the labor or work that human beings do that's created through education, through knowledge, through training, through experience that is embodied in the workforce. So when you receive education, training, experience, and knowledge, it allows you to do things and produce things and goods and services that you never could before. You're trained to become an engineer. You're trained to become an architect. You're trained to become a pilot. You're trained to become a doctor or a teacher or a mechanic. And so when you learn those skills and you gain that knowledge and that education, that is an improvement in your human capital. And companies will be willing to pay more for people that have that knowledge, experience, and training. So investing in human capital and improving it becomes important. And then, of course, the 4th factor of production is entrepreneurship. These are people we think of as entrepreneurs or business owners who take risks and bring together the resources of land, labor, and capital to produce a new product for the product market or to produce it in some new way. And they are paid for their service through profit. That's the income that they receive. So land, labor, and capital can be exchanged in markets called factor markets with suppliers of these resources, which are households in the circular flow, and demanders, which are firms or businesses in the circular flow. And in these markets, equilibrium prices and quantities are established for the exchange of these factors of production. Now, the one factor, entrepreneurship, is not as tangible or quantifiable as the others, and it's not easily identified in the framework of a market, but it is nonetheless quite important to the production of a good or service. So, why do the prices for these factors of production matter? Factor prices play a key role in the allocation of these resources. The price of a resource determines who's going to get that resource and what it will be used to produce and what goods and services it will produce. So it allocates these resources among producers due to 2 features that make these markets special. First of all, the demand for a factor of production is not determined in the same way that the demand for a good or service is produced. The demand for a factor of production is called derived demand, meaning the demand for any input or factor of production is determined by the demand for the good or service for which it was produced. So when the demand for a good or service increases, the demand for the inputs used to produce that good or service increase. And so the demand for factors of production, the factor market, is determined differently than the demand for goods and services. It is a derived demand. But factor markets are where most of us get the largest share of our incomes. Because in a market economy, individuals and households typically own land, labor, and capital. And we sell it to firms and we get income for that. And so that is where we get the largest share of our income, by selling our land, labor, and capital to firms. Think about this. A high school guidance counselor tells you, a student, that nursing is the next hot job. What does this mean? Well, it likely means that there are a lot of job openings in the nursing field at attractive wages. Because if there is a shortage of nurses, then to attract people to become nurses in that field, they have to offer them higher wages to incentivize them to choose nursing as a career field and join that labor market to earn those attractive wages. Well, what just happened? The high wage for nursing positions causes students to offer their labor to this particular factor market instead of another factor market. Maybe, and you're all making career choices. You could choose to be engineers, teachers, nurses, architects, lawyers. What helps to determine what career choice you choose? Well, part of it is your interest in the career field, but also you're looking at the salaries and wages and benefits that are paid to people in different career fields. And careers that offer higher wages will often attract more workers to those fields. And fields that offer lower wages will attract fewer workers. So career fields that are not in high demand will typically offer lower wages and get fewer workers, and career fields that have higher demand will often offer higher wages and get more workers. That is what we mean about the allocation of resources going to where they are needed. Okay? So, in other words, the price of the labor reallocated labor. So students would go from other labor markets, such as culinary school, into the nursing labor market. So fundamental to this story is the idea that the demand for labor and other factors of production is a derived demand. The demand for nurses is derived from the demand for the services that nurses provide. As the U.S. population ages, the demand for medical care and health care, which certainly includes nursing services, rises, and therefore the demand for nurses rises. This is what made nursing the hot job to begin with. So, how is income distributed among these different factors? Well, the factor distribution of income is the division of total income among labor, land, and capital. And factor prices, which are set in factor markets, determine the factor distribution of income. Now, what we will see is of these three factors, land, labor, and capital, labor or workers receive the bulk of the income in the modern U.S. economy. And income for land and capital is less. Imagine all of the income earned in the U.S. is a pie chart. The pie is divided into 4 slices that account for the percent of income earned by each of the 4 factors of production. When factor prices change, the distribution of factor income changes. Now suppose that wages and salaries have been rising. All else equal, the share of national income that goes to the labor factor would increase. Labor's slice of the pie would be getting bigger. Now, the distribution of factor income in the United States has been fairly stable over the past few decades. As I said, in the United States, payments to labor account for most of the economy's total income. For example, in 2007, compensation of employees accounted for most income earned in the United States. About 70% of all income that went for factors of production went to employees for their labor. Most of the remainder consisting of earnings paid in the form of interest to the owners of capital, or corporate profits to the owners of entrepreneurship, or rent to the owners of land and resources, went to owners of physical capital. Finally, proprietor's income is 9.3% of the total. And that went to individual owners of businesses as compensation for the labor and capital expended in their businesses. So what we call compensation of employees is really a return on human capital. When you are paid for your labor, you end up getting more money because you have invested in your education, your experience, and your training. That's why you go to college, to improve your human capital so that someone will be willing to pay you more money for your human capital in the future. What we've seen in the last few decades is that over their lifetime, someone with a college degree on average will earn $1 million more than someone with only a high school diploma. That's why so many people desire to go to college and earn a college degree. Typically, someone with a college degree will earn 111% more in compensation over the course of their lifetime than someone with only a high school diploma. Well, what are you being paid for? Why do college degree recipients earn more money than people with only a high school degree? You're being paid for your human capital. It's a return on your human capital. And that's why you're willing to go to college and get that education and that training. So a surgeon isn't just applying the services of a pair of ordinary hands. He or she is also supplying the result of many years and thousands of dollars invested in training and experience in college, medical school, residency, and internship. Economists now believe that human capital has become the most important factor of production in modern economies. And you can see that in the total compensation that we looked at in the previous pie chart that is going to employees. And a lot of this compensation is compensation for human capital. Now, most of you have held at least one job up until this point. So these questions might help you to understand this particular section of the module. Why should or why would an employer hire you right now? What can you do for them? What can you give them? What knowledge or skills or experience do you have that will benefit them and earn money for them? Well, you might be thinking, they should hire me because I would do a really good job. Well, doing a good job relates to your productivity as an individual. In other words, what you can produce for that employer that they can sell and receive revenue for. A good worker, in the eyes of an employer, is a productive worker. They don't want to hire a lazy worker that isn't going to produce anything for them because they won't receive revenue and make money and profit from that. So they only want to hire really good, productive workers. When you are going in for an interview, you have to convince an employer that you can produce really well for them and that you can produce more for them than any other potential employee could in terms of revenue and profit. Now, what else should an employer consider? Well, this one might be more difficult for you to see. So let me ask you this. What happens once you have produced as many units of output as you can? Now, you might point out that the employer wishes to sell the units that you have produced. Yes, they do. And so the employer also cares about the price he or she will receive when the output that you have produced is sold. Lastly, the employer would need to determine if the benefits that they get by selling that output outweigh the cost or the wage that they have to pay you for producing it. Now, in Module 54, we learned about production functions and how marginal product was computed from total product. Remember, all economic decisions are about comparing costs and benefits. So for a producer, it could be deciding whether to hire an additional worker. But what is the marginal benefit of that worker? If they hire that worker, what's the additional benefit they give to the employer? Well, we're going to go now back to what we learned in Module 54 and use the production function which relates to inputs to output, to answer that question. And for the time being, we're going to assume that all producers are price takers that operate in a perfectly competitive industry. Now, here's a tip for the AP exam. In factor markets, firms are the buyers of inputs and households are the sellers of inputs. Remember, when we looked at product markets, firms were the sellers of goods and services and households were the buyers of outputs. So the principles that guide the factor and product markets are similar, and this should make the factor market easier to understand for you because you've already studied the product market. Now, when labor is the only factor being changed, with other inputs being held constant, this is called marginal product of labor, or sometimes it's called marginal physical product, because you're producing a good or service with it. And the abbreviation for it is MP subscript L, and it's equal to the change in output divided by the change in labor. And we see that in this graph here. So the marginal product of labor tells us how much additional output the next worker brings to the firm. But how many dollars will the worker's efforts bring into the firm? That's the question we haven't answered yet. Well, now we need to consider the price of each cup of lemonade when it is sold. The total monetary benefit of hiring each worker is called the value of the marginal product of labor. And so the value of the marginal product of labor is equal to the price of the output, in this case a glass of lemonade, the price of a glass of lemonade, multiplied by the additional number of glasses of lemonade that that worker produces, or the marginal product of labor. So suppose the price of lemonade is $2 per cup. Well, we can add a column to the table and compute the value of the marginal product of labor. Now here's a graph that graphs the table that we just looked at, and you can see that each time we hire a worker, the marginal product of labor, except in the beginning when they're increasing marginal returns, declines with each worker we hire because of diminishing marginal returns. So again, how many workers should this firm hire? Well, now we add this additional column on the end called the value of the marginal product of labor. And that is determined by taking the marginal product of labor in the third column and multiplying it by the price of a glass of lemonade, which is $2. So if we hire the first worker and they produce 8 glasses of lemonade that we sell for $2, that worker contributes $16 worth of value by what they produce. The second worker produces 10 glasses of lemonade, 10 times 2 is 20, so they produce $20 of value. The third worker produces $16 of value, and so on. We're just multiplying the marginal product of labor by the price of the glass of lemonade to see how much revenue each worker brings in. And that's what we call the value of the marginal product of labor. Now, when we decide how many workers to hire, okay, we have to consider the wage that we are paying to the worker, okay? Because if the wage we are paying to the worker, which is the cost of the worker, is greater than the value of what they are bringing in, then we don't want to hire that worker. But if the value of what the worker is producing is greater than the cost of hiring that worker or the wage, then we should hire them. So again, it all comes back to marginal analysis again. If the marginal benefit is greater than the marginal cost, or in this case the marginal revenue is greater than, and in this case the marginal revenue is the value of the marginal product, is greater than the marginal cost of hiring that worker, which is equal to the wage in this case, then we should hire the worker. And if the wage is greater than the value of the marginal product of labor, then we shouldn't hire the worker. And that's how we determine how many workers to hire in the factor market. Now, notice we haven't included the seventh worker in this chart, because if we go back to this previous slide, we can see that if we hire the seventh worker, they are producing negative marginal product, so we would never hire the seventh worker. But hiring workers, like so many other decisions in microeconomics, requires a comparison of the marginal benefit of the next worker, in this case the value of the marginal product of labor, to the marginal cost of the next worker. And we assume for now that each unit of labor can be hired at a constant wage that we will call W for wage. So, we will hire a worker if the value of the marginal product of labor is greater than or equal to the wage. We will never hire a worker if the value of the marginal product of labor is less than the wage. So we will stop hiring workers up to the point where the value of the marginal product of labor is equal to the wage. This will be the profit-maximizing hiring decision for any factor of production, not just labor, but also land and capital. The last unit of any factor is hired when the value of its marginal product is exactly equal to the marginal cost of hiring it. So here's that rule stated out. Here we see it, the production function for George and Martha's firm. You see their total product curve in panel A, and you see the marginal product of labor with diminishing marginal returns setting in with each additional worker hired. So what is George and Martha's optimal number of workers? That is, how many workers should they employ to maximize their profit? Well, if this is a perfectly competitive market, it's a price taker, and a price-taking firm's profit is maximized by producing the quantity of output at which the marginal cost of the last unit produced is equal to the market price. Once we determine the optimal quantity of output, we can go back to the production function and find the optimal number of workers. Now, remember the law of demand. All else equal, if the price of some good increases, the quantity demanded for that good decreases, and the demand curve is downward sloping. So the value of the marginal product of a factor, any factor, is the extra value of output generated by employing one more unit of that factor. So in this case, the factor is labor, so the value of the marginal product of labor is equal to the price that we charge for the good that we sell multiplied by the marginal product of labor, or how many units that worker is producing. And so VMPL is also known as MRPL, the marginal revenue product of labor. And the general rule is that a profit-maximizing, price-taking producer employs each factor of production up to the point at which the value of the marginal product of the last unit of the factor employed is equal to that factor's price. Very similar to all these other rules on marginal analysis that we've discovered before. Here you see employment and output for George and Martha's farm. So in the final column we see the marginal product of labor that is produced by each worker, based on how many bushels of wheat each worker adds to the total. So we determine the marginal product of labor by multiplying the price of a bushel multiplied by the number of bushels that that worker produces. And that's their marginal revenue product of labor. So, if we go back to the lemonade stand, if the wage of a lemonade stand worker is $8, let's say every time we hire a worker we have to pay them $8. That's the wage. Okay. How many units of labor will we hire? Well, if the value of the marginal product of labor of the next unit is greater than or equal to $8, that's our wage or our marginal cost, the firm will profit by hiring that unit of labor. So, the first worker, the value of their marginal product is $16. They produce 8 glasses of lemonade for $2 each. They bring in $16. We pay them $8. 16 is greater than 8. We should hire them. The second worker brings in $20. We pay them 8. Yes, we should hire them. The third worker brings in 16. We pay them 8. Yes, we should hire them. The fourth worker brings in 12. We pay them 8. we should hire them. The fifth worker brings in $8, we pay them $8. Well, that's where the value of the project of labor is equal to the wage, so yes, we should hire them. But we should not hire the sixth worker because they bring in $4 of value, but we pay them $8. So we pay them more than what they bring in. So no, we should not hire them. So this firm's hiring decision should be to hire 5 workers. We hire up to the point where the value of the marginal product of labor, or any input, is equal to the cost of that input, in this case, the wage. Now, if they're never equal, then you hire up to the point where the VMPL is just greater than the wage. You never hire where the wage is greater than the VMPL. Now, suppose that the market wage rises to $12. Suppose that instead of paying each worker $8, we have to pay each worker $12. Well, now we only want to hire workers that bring in a value of the marginal product of labor of greater than $12, not $8. So now our hiring decision goes down, because if we go to back to the previous graph, the fifth worker brings in 8, but if we have to pay them 12, we don't want to hire them anymore. The fourth worker brings in 12, and we pay them 12, so now we would hire only 4 workers. So you can see this from the downward sloping value marginal product of labor curve, and it's downward sloping because of the law of diminishing marginal returns, that each worker we hire brings in less additional output than the previous worker. And so when the price of labor, when the wage goes up, we hire fewer workers. Our hiring decision goes down from 5 to 4 workers in this case. Now, remember, given the total product and product price, you may be expected to calculate the marginal product, the marginal revenue product, and the total revenue for the AP exam. So make sure you can do all of these things and make all of these calculations if asked to. Now think back to the law of demand. What we see here is the same as the law of demand. So the value of the marginal product of labor curve slopes downward, but it is also the demand curve for labor. It's not just the marginal revenue product of labor curve, it is also the demand curve for labor. So for any factor, the value of the marginal product of labor curve serves as the demand curve for that factor of production. Now, sometimes, because that curve is also the demand curve for that factor of production, we know that demand curves can shift. And what can cause the factor demand curve to shift? Well, basically 3 things. One would be a change in the price of good. Because remember, when external variables change, the demand curve for any product was shown to shift when we looked at the product market. Well, the same is true for factors of production. There are things that can cause the demand for factors of production to increase and shift the demand curve to the right, or decrease and shift the demand curve to the left. And generally, there are 3 external variables that will shift the demand curve for a factor outward or inward. One is the changes in the prices of goods. And remember, demand for a factor is derived demand. So if the price of the product that is being produced with that factor changes, that's an important part of the value of the marginal product. If the price of medical services rises, even if nurses are not any more productive, the value of the marginal product of each nurse will rise. So remember that the factor demand curve looks and acts like other demand curves you have studied, but the causes of a shift in demand for factors of production are different than the causes of a shift of the demand curve in the product market. Here again, we see a graph of the marginal revenue product of labor with imperfect competition in the product market that we will talk about in a second. But let's go back to the lemonade market. Okay? The wage now has returned to the original level of $8. but the price of lemonade is now $4 per cup. So we multiply the number of cups that each worker produces by $4 now instead of $2. So the value of the marginal product of labor has increased because the price of the good or service it is used to produce has increased. So now, how many workers would we hire? Well, remember before we wouldn't hire the sixth worker, but now the value of what they're producing has gone up and it's equal to the wage we pay them now. So now we would hire the sixth worker, whereas before we wouldn't hire them. So because the price of lemonade has risen, we hire the sixth worker. So what has happened? The demand for labor has shifted outward. We've had a rightward shift of the demand curve for labor. And when that happens, you can see at a price of $8, instead of hiring 5 workers, we will now hire 6 workers. And you see that here with shifts of the marginal revenue product curve. If the market wage rate stays the same at $200, we hire 5 workers in the first panel. But if there's an increase in the price of wheat in the wheat market, then the value of each bushel of wheat that each worker is producing goes up. So the marginal product of labor curve shifts outward and to the right, and that covers that higher cost, and so it would increase the number of workers we would hire to 8. A decrease in the price of wheat, shown in panel B, would do the same thing. If the price of a bushel of wheat goes down, then the marginal revenue product of labor goes down as well, and that shifts to the left, and now we would hire fewer workers. Instead of hiring 5, we would now hire 2. Let's go back to the previous slide right here, and I want to talk to you about other factors that can shift the supply curve. Changes in the supply of other factors can also shift the demand curve, rather. So for example, if labor is paired with capital or tools, the labor is usually more productive. So if capital is more plentiful or land is more plentiful, usually the marginal product of each unit of labor is higher. So the VMPL curve will shift outward and more units of labor are hired at all wages. The third thing that can cause the demand curve for a factor to shift is a change in technology. Better technology increases production across the board. Now, in some cases, technology replaces certain factors, like a machine replacing labor, and that would cause it to decrease. But in the long run, better technology allows a nation's labor force to be more productive, and the demand for labor shifts outward. Now, going back to this graph here, what happens if we're in an imperfectly competitive market? What if it's not perfect competition? What if it's a monopoly? Well, we know with a monopoly, the marginal revenue goes down for each unit that they sell. It's not equal to the price because they have to lower the price for all previous units sold. So if you look at the, let's see, was it 3, 4, 5, 6, sixth column here that shows marginal revenue, you'll see it's not equal to the price. And so that would go down. But you would still use the same computation. You would take the marginal revenue, multiply it by the quantity that is being produced by that worker, and that would give you the marginal revenue product for that worker. So you calculate it the same way. And the rule is the same. You take the marginal revenue product of labor, and you keep hiring until it's equal to the wage that you pay that worker, and that's how you determine the number of workers to hire. So even though the marginal revenue curve looks different under imperfect competition, the hiring decision is made the same way, where marginal revenue product of labor is equal to the wage. And the marginal revenue is determined by taking the marginal revenue and multiplying it by the quantity or the price. You take the price and multiply it by the quantity they are producing, and then determine that. Here is a video produced by Mr. Clifford on comparing product and resource markets. Most of what we've looked at in this course is focused on the product market, but this unit focuses on resource markets, or factor markets, and so you can watch this video on ACDC Econ. Let's take a minute to look at this resource video.
If economics is all about how people use their scarce resources to try to satisfy their unlimited wants, then it might be a good idea for us to think about what the term resources actually means. When economists talk about resources, they mean productive resources. The resources actually have to be able to produce something, a product or a service. So what kinds of stuff do we use to produce goods and services? We use people, fuel and energy. We use machines, factories, plants, animals. Okay, clearly a lot of things are used in the production of goods and services. Economists like to simplify things to make the story more intuitive, so what do you say we put all of the resources into just a few broad categories? Land is any natural resource. Sure, this includes land, like farmland or real estate, but it also includes trees, plants, livestock, wind, sun, water, oil. You get the idea. The category labor refers to any human service, physical or intellectual. You're adding to the package of labor services that you have to offer right now by learning. Some labor comes naturally, an athletic gift perhaps, that allows you to play professional ball to earn a living, but you can certainly add to your package of labor services, sometimes referred to as human capital, through job training, experience, conferences, workshops, or education. The category of capital. Now before I go one step further, let me say this. Money is not a resource. Remember what I said about resources? They need to be productive. They have to be used to make something else, and money can't do that. Don't get me wrong. Money helps the economy move along more efficiently, more smoothly. It's like grease for the economic machine. But in and of itself, it can't produce anything. It's used to acquire the productive resources that can produce goods and services. There's confusion that's understandable since most media refers to financial capital or investment capital, so it does refer to money. But what is economic capital? By definition, economic capital is anything that's manufactured in order to be used in the production of goods and services. Well, more simply, capital's machinery and equipment. This includes factory machinery, but also the factory itself in computers, furnishings, books, roads, phone lines, etc. The last major resource category is entrepreneurial ability. What, or rather, who, is an entrepreneur? An entrepreneur is someone who, first of all, is able to recognize a profit opportunity. Second, is able to organize the other factors of production, another phrase for resources. And third, is willing to accept risk. Look, do you know who Joe Johnston is? In the late 1980s, he and his partner left their engineering jobs and opened up a coffee shop in downtown Tempe. Now what you have to realize is that at that time the downtown area was, well, shall we say, a little less than desirable. It was just prior to the revitalization and renovation of that area. And believe it or not, no one had ever heard of a little place called Starbucks, so quite frankly, I'm sure that people thought these two guys were nuts. Bad location, bad product, who ever heard of making a living selling coffee in the desert? Bad idea. Well, Joe and his partner took a chance, opened that first coffee plantation, and it was a hit. Within a few years, they sold it off for millions. These two guys saw a profit opportunity. There's 50,000 plus caffeine-starved students less than 2 miles away. Come on. They took the risk and organized the resources to start that business and make it successful. After selling the coffee plantation, Joe went on to other ventures. Joe's Barbecue, Joe's Farm Grill, and most recently, Liberty Market. That's entrepreneurial ability, folks. Next time, micro versus macro.
Okay, so here is an activity that we will do in class, a worksheet on resources. Here is a practice question that you can do so at ACDC Econ, Micro Unit 5, Question 8, on the hiring of workers in the factor market. Here's an activity we'll do on hiring workers in the factor market. Here's an activity that we will do on the value of the marginal product of labor. Here's one that we will do in changes in factor demand, or shifts of the demand curve in the factor market. And here is a summary of what we have looked at in this module today on factor demand. And so this concludes our look at Module 69, Introduction and Factor Demand.